Good morning, everybody. Welcome to the Flow Show, where we're going to be dissecting Mr. Ueda and Co. and what they've dropped on us or not dropped on us overnight. Morning, Kay. How you doing, mate?
Good morning, Ryan. Good morning, everybody. Yep, I'm doing good, thanks.
All recovered from your little birthday outing? Where'd you end up?
Recovering. Best meal in ages, mate. Really. It's one of our locals. It's one of the good ones, and he made a bit of a special one for us, and was absolutely gorgeous. No, really.
Oh, very nice. Yeah, I saw some of the photos you dropped us in the old Skype.
Yeah. I mean, I had to. It was so good. That was really a great meal.
Lovely. Good to hear. And all plaudits to the missus, I assume.
For organizing everything, absolutely.
Yeah. Hope you put in as much effort when it's her birthday, mate.
Yeah, sure.
Yeah. Cost of coffee and a McDonald's.
Yeah, and a fryer.
Right, let's get into it. The China Securities Journal running a piece speaking to various analysts over there say that the LPRs could be lowered in Q1 after the hold last week. That's the loan prime rate in China could be lowered. Well, Q1's only got 2 months left, so February and March are the key dates for those, but that could be coming over the next couple of months. We did get what could be classed as a fairly sizable headline at the outset. Bloomberg dropped a sources piece, as I often like to do, saying that China is potentially looking at a stock market rescue package backed by $278 billion of funds. This package, or this backed package, the money will come from offshore accounts of Chinese-owned state enterprises and will be put into a stabilization fund to buy shares onshore through the Hong Kong Exchange link. That's the link they have between their businesses in Hong Kong and the onshore China stock exchanges. They have also apparently put aside 300 billion yuan, which is obviously much less than $278 billion, of local funds to invest in onshore shares through their China Securities Financial Corporation, or the Central Huijing Investment Limited firm. So some could call it a little bit of a bazooka for that. As we were saying, they needed to step in big. It's not as big as it seems on paper. This stabilization fund and stuff has been touted before, so that's not new news. The amount for China, it's not big. 278 billion isn't big. Might be to everyone else, but it's been taken by the market not as positively as they may have hoped. If we look at stocks here, and I've got some notes on there as well. Not an awful lot happened on that announcement there, this 278 billion stock stimulus. When we got that short selling ban starting to be announced, an intervention, we saw that pop. It still carried on going down. So, nothing in this price action. This is just an hourly chart. If we zoom it out, nothing there looks like a big recovery, or that the market believes that this is going to work. And I think that's the main message here. This isn't as big a bazooka as maybe some in the market expected. And perhaps it's just a bit of papering over the cracks and more to support the domestic side of things. Doesn't change the fact that investors, particularly foreign investors, are leaving the market. Well, some are anyway. And that the economy is still facing issues. So this may help with the domestic investors as they go into the new year, but it's not looking like it's changing anything of the rhetoric there. What did you, I don't know if you picked up the bits and pieces, Kay, what did you make of those headlines?
Well, it's it's still a pretty decent amount, and it just comes onto the rest, right? Well, I would argue it may. I'm not saying it's going to completely stop this move, which may, as you have posted as well in our room have to do with other stuff as well. Um, it's still a decent enough package. But it's all the question is always are the big investors at one point going to find it enough that China is doing enough to revamp everything? And yesterday there was something, and we spoke about that already in the past. There is something really, really, really valid as well as an argument. Is China willing to add some water to their wine in their external and geopolitical side and in the trade relations? That would be a bigger event, probably, than just continue to pour money into the system.
Yeah, yeah, very much so. Because we can see from that short selling ban intervention, market still sold off. They've done it in F.A.C.E. They're keeping the price contained, but they're not moving it significantly the right way. So it's like pouring glasses of water on the fire. You're not going to put it out just yet. But I think you're right. I think they need to step up on the international side of things, the export side of things, and make moves there before foreign investors particularly, come rushing back into China. They've got into bed with Russia. And that Ukraine thing, and that's a huge part of this as well. The market saying, right, well, you want to get in bed with Russia, fine, we'll decouple from you even more. And that's the sort of time you start maybe getting headlines. China pushing for peace talks or something like that, where they want to become the hero, because it's costing them money at the moment.
It is. We had a little bit of that when the US and China restarted at least the dialogue. And sorry, we have seen that in the meantime they already had a couple of teams meetings, but we haven't seen anything yet come out of those meetings that are going to tell the big investors, saying like, okay, this is the time to get back into China. And also in the meantime, as you have posted in the room, it seems that some funds have been playing some kind of strategy which completely exploded in their face and were frozen out. And I think that is perhaps a part of what we've seen the past week and a half on those Chinese stocks, and perhaps the Nikkei as well on the other side, is that people forced to get out of recovery trades on China. So we may be in for a bit of an interesting couple of weeks to come if we hear more about those stories. Or I heard this morning BOA is also letting 20 investment bankers go who played the same kind of strategies, China versus Japan, and it exploded in their face as well. So there may be some of that going on as well. So we'll see once those positions have been cleaned out if the Chinese stock markets can regain some sort of footing. If not, then it's still too early to re-enter China. I'm watching it. I mean, there's going to be a time where it will hit the bottom. But as you rightfully said already, also a couple of times, they need to get their international trade and relations back on a better track than what they are now.
Yeah. And that doesn't mean they can't pull out any bazookas like this 278 billion stuff, and they've got the will and the facilities to intervene in markets if need be. It's just not a permanent fix. And that's the thing you have to look at. So you may get short-term bang for your buck, but whether it lasts is another question. But anyway, moving on from China, they're not going to go anywhere. I'm also wondering, maybe they're waiting for the US election because they won't know who they're going to be negotiating with. And Trump might be a whole different kettle of fish to Biden if that's how it turns up. So that may be an aspect that will keep them sitting on their hands a bit as well, not knowing who they're going to negotiate with. But that's for the later. Right, over to his nibs at the BOJ, who kept their rates unchanged, YCC unchanged, everything unchanged. The only place where changes came was in the forecasts. The fiscal year 2023 CPI or core CPI one of the core CPIs, was unchanged at 2.8%. For fiscal year 2024, the core was lowered to 2.4% versus 2.8% expected. That was touted by various sources a couple of weeks ago, a week or 2 weeks ago, you may remember. I said it may come down to the mid 2% mark. Well, it's gone a little bit less than that. What stats are you after, Bran?
Perhaps just an illustration.
I can show you the if you're after the forecast, I can show you the forecasts.
Well, I think Brian just wants to see the data page as you usually do at the start of the show.
Okay, well, yeah, nothing on there. The data isn't on there for the BOJ brand, but there you go. There's the forecasts there for you. So yeah, fiscal year 2025 inflation was raised by a pip to 1.7%. That one down there. So this is where all the main forecast changes were. Everything else was largely unchanged. GDP was lowered for the 2023, but raised for 2024, unchanged for 2025. So those inflation forecasts went down as expected, maybe a bit more than the 2.5, which most people would call the mid twos. So that confirmed the slight dovish slant to things. In his presser, Ueda said that the economy is to gradually pick up in the months ahead. The likelihood of achieving a 2% inflation target is rising gradually, and confidence has grown in achievement of the price target. Certainty for the BOJ's outlook is also rising gradually. However, the old lines come in just to keep everyone's feet on the ground. They won't hesitate to take additional easing measures if necessary. They've heard encouraging comments from big companies regarding wage hikes and want to confirm the virtuous cycle of wages and prices is in place. They will be closely watching the outcome of spring wage negotiations. Now, there's a couple of comments where it starts to get a little bit more hawkish. They're going to look to see if negative rate should be kept if the price goal is in sight. So not hitting it, but if it's in sight. We'll certainly foresee further rate hikes when exiting negative rate policy. That's a bit of a repeat comment on there. Here's the real key comments as you can take them. Even if real wages are negative, if the outlook is positive, a policy change is possible. And monetary policy change is possible when there is no update to the quarterly outlook, i.e. if nothing is changed in those, and one could assume change to the downside. So these forecasts you can see here, these come out quarterly. One would assume that last line relates to not bringing down inflation numbers. So if these stay unchanged for the next quarter at least, then perhaps that puts them closer to ending it. The last but one comment I read there, even if real wages are negative, if the outlook is positive, a policy change is possible. That's some have taken that as a bit of a bullish comment, i.e. it's not just wages confirming that will cause them to end easing. It's probably just a bit of a reminder that it's inflation that is the most important thing, and wages, as important as they are, make up that inflation picture. It will be inflation that rules the roost regarding policy change. You know, if they only see 1% wage rises in the spring, but inflation's at 5%, they will tighten on the inflation at 5% irrespective of wages. But as I mentioned in the chat room, they want wages. Kishida wants wages. He wants this virtuous growth cycle to pick up, because if you get better wages, you get a better economy, more spending, and inflation naturally follows behind it anyway.
And he's getting
inflation. Yeah. But inflation without a good economy is a different kettle of fish altogether with which to decide monetary policy. Overall, I would say a bit more, I wouldn't say it was hawkish, but a bit more positive on the comments. More positivity than, we're still waiting, we're not there yet type comments. So it's another, in my opinion, small step. We're on the right path. We're continuing to get where we want to go. Just waiting on the ducks to line up in the spring and other things. Kay, your thoughts?
You've said it all, mate. We've said it. The base case is exactly what happened. Evolution in the rhetoric and keeping everything as it is right now. That was the base case. No surprise on the YCC. It's just as we were yesterday. We're a little closer to the normalization, and that's what we've been saying endlessly since Ueda stepped in. It's going to be slow. I mean, he's going to evolve on the rhetoric. That's exactly what we have. Getting a little bit more, if you can call it even hawkish, saying that they are getting ready. They'd love to see those higher wages, but I guess April. But unless I think he just psychologically left the door open to March with that line that they don't need to have an outlook meeting to change rates, or that's perhaps for the ones after, you know. But I guess they're going to sit out the fiscal year, end of March, and then April, bang, they will put the rates at least at zero, perhaps a psychological plus 0.05% or so, who knows. In what kind of increments they will move, but they will probably not move it fast enough so to unsettle government funding needs. So this is going to be Japan, right? We're going to get out of negative rates, but it's going to go at our pace. It's going to go at the government's pace, so that they continue to feel comfortable. And we are getting out of negative territory, so our regional banks are going to start to make money again, and that's it. Nowhere near speeds and amplitude of what we have seen from ECB, let alone the Fed. No, this is not going to be Japanese style. So we are, to me, there should not be anything completely new in the market now. Is it bullish, bearish yen? That's a different story altogether, but that's what the people listening to our show are very interested in. To me, that the problem for the yen is still the same. Even if March is on the cards, it's the 19th of March. That's nearly 2 months away from now. If you want to be long yen, you're going to need to have other factors than just the yen in your favor. Or, first of all, get those higher wages being a reality, because the market will really bank on that. Secondly, and perhaps the rest of the world starting to talk more about cutting rates, and then and that's one maybe where it's a bit less obvious, but it will be the case if the yen volatility in the FX vols are coming off. That may, in this case, play a bit in favor of the yen, because buying downside in yen pairs will get cheaper. So those are the possibilities for the yen to strengthen, but you still will need to be right quickly, because otherwise the funding is going to bite. And I guess the market, it's not abnormal that we are where we are now, and that is bang in the middle of where we have been trading of late.
Yeah, and it should be noted, I still think that as big a news as it is, the market has been prepared long enough for this. And aside from a confirmation move, if and when they finally pull the trigger, I'm not expecting a complete collapse in yen pairs unless they start signaling they're going to hike 25 pips each meeting for the rest of the year. It's going to be slow and steady. So I'm going to expect we look at the reaction here, down to 147. Yeah, decent move. We had a little pop on the unchanged number, 100 pips lower, a bit more than 100 pips lower, hit the big support area. This is a long time number, 147, lots of action, and we've bounced from there. So door to door, 150 pips, 160 pips, give or take. So that's on Ueda stepping more and giving us the boxes that need to be ticked before they start ending negative rates. So anyone who wants to short this, fine, but be wary that we don't get a buy rumor, sell fact type situation, or sell rumor, buy fact, whatever way you want to look at it, whatever side of the P you're looking at. And, you know, I'm not expecting a move down to 130s. I'll be surprised maybe if we get down from here, maybe down to 145, 144 on final confirmation, obviously depending on where we are at the time. And then we get into, right, they've normalized. What are they going to do now going forward? Is it going to be 10 pip hikes once a quarter or what? And then that will give us the next move.
If really they do only 10 BPs a quarter, I prepare for new highs in dollar yen. Really, I mean, it's going to fly. They need to be a little bit more hawkish than that, in my opinion. If it's really only going to be 10 BPs, it's that's what I said in at the first meeting phase this year. I said if that is the case, then dollar yen closes the year higher than where we started, and I'm still of that opinion that it could very well be that the yen is hitting fresh lows this year because the Bank of Japan is just so slow, and the rest. As we've already seen, the market is a bit forced in repricing expectations on the rest.
Yeah.
Imagine that they don't give us 5 or 6 cuts this year. That repricing will need to go even further. Not necessarily much higher yields, but not lower yields will already be enough, because the yen yields are not going to catch up if the Bank of Japan is only going to do 10, 15, even 15 BPs. A few meetings is not going to be enough to support the yen for longer. That's just my opinion.
Yeah, and it keeps the cheap funding available for people to play the yield trade. So, yeah, we've been stressing it for a while. We're going to continue to stress it. Don't expect huge, 1,000, 2,000 pip moves. This isn't going to be the same as when the yen was rallying all the way from the low 100s up to 150s. I'll be very surprised if we move out of this area on the downside or move out of that area on the top side, unless, as Kay says, the market takes a very dim view of their tightening, and there's a big repricing of expectations for the other central banks, the Fed and whatnot. So anyway, that's where we're at. Dollar yen, bang in the middle of the range. Look at that, same as everything else at the moment. As its move reverts to the medium, if you like, the middle of the range. So we're watching 148s up to 149s, and we're watching 147s. BOJ is over until March. Watch the data. That will give you your potential moves to the edges of the range, both the US and Japan. Yeah, if you're looking to short this pairs or other yen pairs for a big BOJ move, you might want to sit on your hands for a bit until the next meeting and see what happens there. Right, just moving on. Last Japanese headline story in Nikkei citing a think tank says that Japan's pay needs to grow 3.6% to outpace inflation. Obviously, depends on what inflation's doing, but that's the sort of level they're looking at for wages. I think Kishida's looking at beating this year's gone, or last year's wage negotiations. We're probably, where would you say we're at? 3.84%?
Yeah.
Is a good target to look at. Yep. Anything less than that will be a bit disappointing. Anything more will be a bonus.
Kishida has an issue, right? Because there's been some problems in his faction. He's dismantling it or disbanding it, or how you call it. He's got a bit of political issues as well, so he is going to need something positive out of those wages. So he's pushing as hard as he can. But we have heard from certain unions and certain organizations that we could be hitting those levels high enough. All right.
Yeah,
that's the thing.
Yeah, definitely. Gordon, yeah, the vol has dropped. What happened to dollar yen? It used to be cool. Yeah, we've actually seen a drop in vol. It was trading above 9% on the 1 month. At the money's sort of 9.5%. this morning we're down to 8.71%. It was as high as 9.35% earlier today. So yeah, it's right on its lows at Vols. Still above 7, which still keeps it moving enough, but it's been above 9 for quite some time, particularly coming into the new year. So let's see if that dribbles lower like everything else.
Yeah.
Euro dollar 6.2%, cable 6.8%. Quite times at the moment, but let's hope they don't drop back further. Yes, mate, go on.
Yeah, for the moment, it's just the event risk which has been priced out, and now we will see in the upcoming days with the rest of the central banks. Just I'd say if you really want to look at the vols, get the FOMC out of the way, and then we will see what the market wants to do with all of it.
Yeah, very much so. Right, not a lot other headlines that I've got. The EU's 800 billion recovery fund is being held back by red tape. No surprise to any regulars in our chat room or Forex Flow. That's according to industry insiders. All this recovery money that they put together, COVID recovery fund, still held up, not being dispersed or being dispersed in bits and pieces. 2032 was our forecast for when that would all finally happen. So we got 8 years for them to get it sorted. And this won't shock you either, this headline. The Fed watchdog has cleared former members Kaplan and Rosengren of legal wrongdoing. This is regarding them and their trading accounts while they were in the hot seat as governors on the FOMC. They were all caught trading. The watchdog, the Fed watchdog, investigating their own people, has cleared them of any legal wrongdoing, but they have chastised them for undermining public confidence in the central bank. So there you go on that one. No surprises there. Geopolitics headline that also came out last night that Israel has proposed or supposedly proposed a 2-month fighting pause in Gaza for the release of all hostages. Maybe that will lead to something a bit more. There's a few other countries now getting a bit more interested in putting an end to this. So maybe that will be the start of something if it comes to fruition. Israel still strongly adamant that they're going to fight Hamas irrespective of any pause. But things have got to start somewhere, and we hope it starts somewhere soon for everyone involved in that. That's it from the headline front. Kay, unless anything you picked up from the Dorchester Echo while you're eating night?
No, not really, mate. I think you covered everything that could or possibly be market moving. I think tomorrow will be a more interesting day, just for the people to continue to monitor those treasury issuances. It could potentially move the dollar a little bit around the time of the auctions. We've got a 1 year and a 2 year later on in the day, if I saw that correctly. So, but we already spoke about it yesterday. Very light on the calendar. I think tomorrow, PMI day. That's where this week may get underway for good. In the meantime, it does look like we are going to respect ranges in most of the pairs. Worth noting is that the dollar is finding support on most of the pairs, right? Still finding a bit of support. Euro dollar can't stay above 109. Aussie has a bit of trouble to stay above 66. Kiwi is looking a bit fragile. It's the dollar is still looking good, and that, is something that I was talking about last week. I said be careful, because who says all those issuances, it's if people externals want to go to the auctions, they will need a few dollars in the process, right? Nothing that numbers cannot change. The numbers data will change the picture if they come out far away from expectations, but just the under the surface, a little bit of dollar demand, it seems.
Yeah, very much so. I think we're in the same boat. We have got data coming up this week. There's not much today, as you can see there. Just some some Richmond services, which you just keep a half an eye. It's a bit the same as the Philly and the Empire, just a regional number. Forget Eurozone consumer confidence, the number that's only been positive 4 times its entire history. And then we get stuck into the PMIs starting in Asia overnight, and then it's PMI day tomorrow, amid all some other bits and bobs and those auctions, as Kay mentioned. So really, I think trading wise, we've not got a lot of movement. I do think whether some of these majors were moving just because yen pairs moved, but they've gone back into ranges. It's all still small moves. As Kay mentioned, Aussie dollar, had a little poke above 66, found the prior high too much to handle. When we're back below again, it's still not breaking down this trend. So anyone who's long still, like me, talking my book, it still looks fairly constructive, back below 65.70, and the mood changes and the picture changes and it looks far more bearish. And as Kay said, euro dollar doing the same, little peep above resistance, didn't like what it saw, and now we're back below, testing the old zone down here. Certainly I've got no interest in messing around in the middle of this, but it may suit your scalpers to pick the levels. Euro sterling is, we're right on the level at the moment. We had that first test, we had the bounce, couldn't even get up to the big figure. Then when you come back quickly, it looks like we may be heading below. It's still putting up a bit of a fight down here, 85.50. But if that goes, then we may be on for a test down towards the 85 figure down here. There's still a few little bits and pieces in the way of that, coming in 85.25 and whatnot, but that would be a first indication if we get below this 85.50 number that we may be going to do a bit more. Ali, what are you up to today? Ali is in dollar Swiss. I'll let Kay look at dollar Swiss in a moment. I know he's watching that intently. Talking about if peace persists, then what will be the dollar reaction? I wonder if dollar will not get war-related strength. I think you've got to look at it's still contained. Okay, the Ukraine stuff, the Israeli stuff, the Red Sea stuff. It's still all contained in its own bubble. We've not seen a huge reaction in oil, as you would expect. We've not seen a huge reaction in gold, as you would expect, if the market was really trading that risk. So if there's peace ensuing, we'd probably see a bit of a risk rally. I wouldn't think that would be anything huge. Is it enough to bust euro dollar out of range? You've got 105, 112 there. I very much doubt it, but it might bring a few pips. But if we test the edge of a range or some of the bigger levels, maybe 110, for example, and we can't break it, then that's the range confirmed. Yet again, you know what to do thereafter. The levels have been set in play, 110 recently this year. So a risk rally perhaps gets us up there. Downside, 107s maybe. If we don't get through there, again, we're within the range, you know how to trade it. I'm not it's just about sitting and watching and waiting. S&P is still doing okay, though it is just starting to run into a little bit of trouble on the upside. Let's go into the shorter one. I did paint a couple of lines. As I've said, when you get a big break of a level, particularly into uncharted territory, and if you don't use fib extensions like I don't, then I just watch to see where the price action develops or may develop. So I plotted a couple of levels here. One that was showing that we couldn't get above and hold around about 48.60. We had a little pop yesterday, but that didn't hold. So 148.60 is building as resistance. I'm up this level, 148.50s, call it 49.50 as potential for support, and we're largely holding it. Very tight range, so something's going to happen eventually. But this gives you a bit of an idea how the price action is developing. Obviously, the big number is down here, 48.20. If we get a test down there, we may do. We need to see how that evolves. That will tell us whether this rally, this break is going to continue or whether it's going to fail. But until then, I just plot the little levels. We've got another one up here now, this high, 48.70. We're talking 10 pips between each one. So this is nothing I'm going to rely on right now, but over time, the picture builds, and then 2-day trend turns into a weekly trend, turns into a monthly high. That's where you get your levels from moving forward. But for now, I'm still long. I didn't take off up at 70s. I was looking for a little bit more. If I get above 70s, I'll start to yank my stop up on my longs behind it and then see what it wants to do thereafter. Kate, did you want to have a little look at a couple of bits?
Yeah, I've already upped my stop just to just below that prior high. I just don't want to risk too much more, you know.
Yeah.
I'm long S&P as well.
Yeah, you vultures all jumping in. I've planned this for 2 weeks, and all you lot jumped in 5 minutes before it happened.
Yeah, of course, but that is just to help you, Ryan. Okay, I mean we've helped the market get to your stop entry. I mean, Adam and myself, we just went like, all right, let's give Ryan a hand and let's push it up a little bit for him. And yeah, so we've been helping you, mate. I mean,
all help.
That's what friends are for.
Exactly, all help is warmly welcomed. Until
right.
it starts moving against you, then you'll all run out the door faster than my legs.
Okay, dollar Swiss. Ali, it's an idea like any other. I'd find this for as long as this starts to look like a bit of a bull flag if for people who watch that. You've got to get below 86.5 to start with. Then you have those prior low, prior high. It bounced off of this level around 86.30. Fine, can get there. Why not? Depending on what the dollar does. Euro Swiss is a little bit less buoyant today, so that may help you. But all in all, I think we are still in this little channel that we started to build from the fixing at the end of last year. So to me, still all in all looking relatively constructive for as long as we stay above. Let's call it round it up to 86 right now, or it's 95, 85, 95, but round it up there. If we start to get back above 87, the figure 87.05, then I think we are on our way to our next zone around 87.30s, and then up in the more higher 87s. And again, as I was saying already a number of times, to me the magic level will be around here, these 88s. If that breaks, then I think Swiss is going to weaken further. But okay, first things first. So intraday, yeah. I wouldn't keep it if this would go through 87, but it's a short-term position, so I really don't can do anything around here. I think overall the dollar seems a bit rangy to me. So it's also the reason why I let my cable go this morning, because I can see some resistance coming up and running a bit out of steam here, up in this 127, call it 127.5. That's going to be an interesting one. I think if it breaks above, then we are going to have a better chance to get back up into the high 127s or even the 128 again in the cable. But in the meantime, it may just start to look like a bit of a range play as well, right? Like this kind of thing. And then, yeah, euro sterling. I think euro sterling is going to be interesting if we break this support here, 85.5. It's really where it is. And thanks to Simon for showing this the other day, it could mean that we are on our way again to the low 85s, and then really needing to reassess what's happening there. I'm still a bit short, and I'm patient on that one, seeing what's going to happen around here. If it gets back above 80, that 85.90, which kept so far, you know, we had like a couple of times we went back into the 85.90s and it kept already. For as long as that keeps, I'm going to try and defend this one. Just an interesting one for those looking at an 85, the figure as well. Give and take pips, okay? Because that was one of those highs where people were wondering what's the real high on the euro sterling post-Brexit. But look, it's in that zone. The 38.2 is around 85, okay? It is still going to show up as a level in the euro sterling, I think, even if it's already getting that old. We have seen that it has sort of stopped around there as well. So I think the low 85s is again going to be important if we get there. One that I did not step in yet again, because I'm trying to be patient on this one, is that silver again peaked below, had a peak below 22, and again is trying to put in a bounce. Okay, would be interesting if this thing starts to reverse. If we break above this 22, call it 22 and a half, and holds, I may add just a little bit to my long-term longs and put it in the drawer for later. I'm still looking for if it comes back down here in this zone where I expect a lot of support, and that's definitely where I'm going to add a few to my longs. What else? Any thoughts on the 10-year yield?
Yeah, go on.
You know, Gordon, I think we have to look at all those issuances this week for one, and then the PMIs tomorrow. Okay, I think if ever we come back into this zone, I expect a lot of the repricing that had to be done, pricing out cuts and everything. It's a possibility that we get back into this zone above 420 up to 430. In this zone, I would expect personally the bulk of the repricing to be done and then see what is next. Okay, it may happen this week on the lots of treasury issuances. The most is in the belly, by the way. Not really a lot going on in the longer end, but it could just drag the rest up as well. And then we will see on the PMIs. Okay, I think 390. Even though we've been below here, but I think 390 is a bit your do or die level because psychologically you're moving away from the 4% level. If that breaks again, then I think something may be wrong with economic data in the States. All right, so that's sort of my view right now on the US 10s. I'm data dependent really, and treasury issuance dependent to see what if the market goes to the auctions or not. That's about my view on right now on the 10-year yield. Ryan, I'm going to give it back to you, mate. And I'm not looking at too much more right now. What am I looking at? Do I look at other stuff right now? No, not really. I think, yeah, your dollar yen is exactly where it is, in the 147s there. I like that as a support as well, the first support line. But I think we are going to have to look on whatever yen does in the crosses as well, because they will have a clue, not only the dollar yen, like for instance on the euro yen, you're gonna have to break up below 160 to get a deeper move, and then there's a bit of a trend line here, but that's been traversed already a number of times. But I think the first one is 160, and if you look at sterling yen, you've got that support here in the low 187s, and you also got a broken trend line here also coming in the low 187s. Those are levels, in my opinion, that are going to need to be broken, and you can find them back on the other yen pairs as well when you look around. We need to break below for the yen to gain more traction, in my opinion. Okay, that is
that euro yen, that 160ish. It looks a bit like dollar yen's 147. So that might be one to keep an eye on today.
It does. It does. It does.
So whereas dollar yen hit its decent level, that 160, was it 160, 10, 20-ish? Yeah, that looks like it might be a decent level. If we get down there today, it might be something to take a couple of try and take a couple of pips off of. But yeah, we're slow going at the moment. It was very slow going yesterday. It looks like it's slow going again today. Just adjust your trades to match the conditions. You know, don't go getting a trade and looking for 100 pips. If you get some money, take it. Keep a piece on for interest and see where it goes. But don't get caught in anything silly at the moment.
Back over to you.
Yep. And on that note, we shall call it a day. And good luck with or good tidings for the rest of your trading today and the rest of the week. We will be back tomorrow as always to see what mess the markets has left us. Trade safe, trade well. Thank you, K-Man. And we'll see you all tomorrow.